So Liberty Broadband is a pretty complicated situation, and it came about because we've been looking at the Liberty vehicles for quite a while. We own Liberty Media. John Malone, widely known as the cable cowboy, he's really led the cable industry for the last 30 years. He's become very rich himself, and he's made a lot of other people rich along the way. It is a complicated situation. Liberty Broadband doesn't actually own the assets we're going to talk about, but its biggest asset is actually a stake in Charter Communications. Now, Charter Communications itself is set to become the second biggest cable company in the US. It's currently made a takeover offer for Time Warner Cable, and if that wasn't complicated enough, it's also made a bid for another smaller company called Bright Networks. Now, the company, once it actually gets approval to make the takeover, Charter will become the second largest cable company in the US. And so what we expect from that is Tom Rutledge is going to be able to get a hold of those assets, rip a whole load of costs out, dramatically increase the cash flow of Charter Communications, and then he'll be able to start paying back a lot of the high debt load that Charter currently carries, and then he'll start buying back shares. And this is really the typical John Malone cable story that we've heard for many years. What the company really needs to increase its cash flows is a huge amount of assets where it can have a lot of scale. It's really a case where the biggest companies win most of the market. So that's the reason we like Liberty Broadband. It's because of its stake in Charter Communications, and we think Charter, once it gets approval to take out Time Warner Cable, is going to drastically increase its cash flows, and that should produce very high returns for shareholders. The reason we bought Liberty Broadband rather than invest in Charter Communications itself was because Liberty was actually trading, when we bought it, at about a 12% discount to its net asset value. So in a sense, we're getting a discount to own Charter Communications by buying Liberty Broadband rather than invest in Charter Communications directly. The other thing we like about Liberty Broadband is this is where John Malone's actually got his money invested. And I think one of the reasons why a lot of big investors are invested in Charter rather than taking the discount in Liberty Broadband is because it's a much smaller business and it's somewhat more complicated. And so that's an advantage for us as a smaller fund manager. It means we've got enough liquidity to invest in Liberty Broadband and take advantage of that discount in a way that if you were managing billions and billions of dollars, you simply couldn't build up a big enough stake in Liberty Broadband, and therefore you'd have to invest in Charter if you want to take advantage of the opportunity, and you'd miss out on that 12% discount. So there's a few different reasons. First of all, it's a really complicated situation, and a lot of investment managers don't want to get involved in such complicated situations. For us, that was a competitive advantage, because I think if you look at a lot of these Liberty vehicles, they're very highly geared and they don't report very good GAAP earnings. But if you've read The Cable Cowboy, which is a book that takes you through the 30-year development of the cable industry, you really get to see how John Malone's built these businesses. And what he focuses on is stable businesses in the cable industry that produce lots of cash flow, and then essentially gearing up those cash flows in order to buy back lots of shares and create plenty of value. So in a sense, these sort of businesses don't actually screen very well if you're a fund manager looking for a high return on equity business or a high earnings type business. So that's one reason we uncovered this stock. And I think in the current environment where valuations across the board are pretty high, you need to delve into some of these more complicated situations to uncover value. The other reason a lot of companies aren't investing in it, as I said before, is just the liquidity of the vehicle. Our size in this case is a competitive advantage. So the fact that we're familiar with John Malone, we're familiar with his playbook, and we own other companies in the Liberty stable, gave us an advantage, along with the fact that we're able to have enough liquidity in Liberty Broadband to take advantage of the discount compared to if you bought Charter Communications itself. So the reason our view differs to the market, and we were able to buy this stock at what we thought was an undervalued price, is because a lot of people are looking at these cable companies and seeing cable video or TV subscribers falling off. Now, Charter actually has the best technology in the industry, and we actually think it is picking up market share from a lot of other rivals. So it's not like overall there's been this mass adoption of online and over-the-top services and all these people leaving cable. It's actually been some rivals in particular have lost far more than everyone else. So that's the reason we like Charter. It's got the best technology, and it also offers a triple play. So you're far less likely to give up your services if you've got your home phone, your cable TV and your broadband internet service all getting provided by one provider. at a discount because you're buying all three services. So that keeps the churn rate low. So we don't actually expect video subscribers to increase over the next 5 or 10 years, but what we do expect is a big increase in broadband internet subscribers and increasing prices for broadband services. And if you actually look at it, if you think that people are going to continue to move away in droves towards more online services like Stan here in Australia, it's actually a good thing for broadband internet, because you need a very powerful broadband internet service to be able to run and watch TV and movies. And that's what Liberty Broadband, via its interest in Charter, has. These are monopolistic positions in America. It's not like 10 different cable or broadband internet companies all compete in the same area. There's usually only 1, 2 or maybe 3 services. And so essentially you have this monopolistic asset with monopolistic pricing. And so I think that's a very good situation where, one, we don't think video subscribers will move away en masse like the market is thinking. Remember, Charter has the best technology and has the triple play, which actually might become a quadruple or a quad play in the years to come if they offer mobile services as well. And then on the other hand, this is a business where even if video subscribers do come off, we still expect rapid growth in broadband internet.